What's up, everybody? Welcome. Now, today, this is going to be the most important section, right? So we're going to talk about risk management. Now, a lot of you people, a lot of you guys already know about risk management. A lot of you guys already know how to manage risk, what sort of risk you're going to use, what sort of if that's going to be, you're going to use a static risk, dynamic risk, where you're going to put your stop loss and stuff like that. So we're going to go over all of that. Now, before we start, this section is going to be divided into three parts. The first part is going to be about different types of risk or different types of stop losses that you want to use. The first one is always going to be the static risk. The second one is going to be the dynamic risk, right? So these are very important, static risk and dynamic risk. Now, the second part is going to be about where exactly to put your stop losses and how you can use static risk and dynamic risk in actually putting your stop losses, right? So let's say you're going to have a stop loss, and now you have to identify whether you're going to use a static risk or a dynamic risk. Now, before we begin, dynamic risk is a little bit complicated. It needs a little bit of a practice and a little bit of intuition trading. Intuition trading is basically when you're anticipating a certain move, or you're anticipating certain, a retracement or liquidity grab. So that's where you're using dynamic risk. So we're going to go over that too. Now, the third part is going to be the most important part. The third part is going to be how to reduce your losses, right? This is the only way that you can come out of that break-even stage, because a lot of people get stuck in the break-even stage, and the only way to get out of that break-even stage is to understand how to reduce your losses. So we're going to go over all of that. Let's get into it. Okay, first we're going to talk about static risk. Now, whenever we're talking about risk, we are basically talking about risk in terms of 1% to 2% risk, right? So static risk is going to be, so let's say we donate static risk with SR. Static risk is, let's say if you're a trader and you're trading and you identify an opportunity, you're going to use, let's say, 1% risk. That's about it. That's the only thing you're going to use, 1% risk. That's it. Now, next is, let's say you have a $1,000 account, you have $1,000 account, and you want to risk 1%. Now, what's 1% of $1,000? That's around $10, right? So that's around $10. So you're going to risk $10 in the anticipation that a trade goes your way. Very, very basic stuff, nothing complicated, nothing really advanced at this point right here. Simple. You got $1,000, you're risking 1%, and your risk is going to be total $10. Now, let's say if you're risking 2%, so your risk right here is going to be around $20, right? Now, what does this relate to in lot size? Now, listen. How to calculate lot sizes, how to calculate your risk and pips in terms of lot sizes, it's already explained in our risk management section in Market Fluidity, right? So go over that. This one right here, we're going to keep it very simple, and we're going to go over dynamic risk. Now, static risk, let's say you have a candle, and the candle is pushing bullish at this point, and let's say we're at support, and you want to take a buy at this point, right? So if you take a buy, you can take a buy right over here. You got your little buy over here, and next candle goes up. Your total risk at this point was, let's say, 1%, right? So you took one position. Let's say this position could be, 10-cent lot. This position could be $1 lot. This position could be, let's say, your 4 lots here as well. So you just took one position. Price went in profits. If price would have came down, it would have hit your stop loss, and you would have lost exactly how much you would have risked. Right, so that's static risk. Very, very simple, nothing complicated, very, very basic stuff. Now, I know a lot of you people have some questions. We're going to keep those questions to ourselves, because as we go along, all those questions are going to be answered. Now, next we're going to talk about is going to be dynamic risk. Now, dynamic risk is where things get a little bit complicated, a little bit advanced, but not so advanced, right? So let's talk about this right here. Now, dynamic risk, we're going to denote this by DR, okay? Now, let's say you're a trader, and you're very disciplined. You don't want to risk a whole lot of money at this point. You're very, very risk averse at this point. So let's say you're going to go with the total risk that you're going to use is going to be 1%, right? Let's say your total risk is going to be 1%. If your total risk is 1% and you don't want to execute this whole 1%, it's always a good idea to break this down into 2 positions, 3 positions, 4 positions, right? So sometimes what guys do is they'll break this down to 0.5% risk, 0.5 and 0.5, right? Now you got your 2 positions. 1 position you can enter first, 2nd position you can enter later. Now, sometimes when you enter the 1st position and now you want to wait to enter the 2nd position, price may already move. When price already moves, you're only stuck with just 1 position and you had no opportunity to add that next position. Now, that has sometimes happened to me as well, right? If I would say, like, a price has to go down, and I would take a sell, and then I would say that I'm going to enter another sell as price retraces. Instead of retracing, price just continues moving, and I'm just left with just 1 position. That's very, very normal. That comes with using dynamic risk. Now, for example, let's say we have a 2 lot, right? Let's say your total risk, based on your stop loss, based on your, the amount that you're willing to risk, you're going to use 2 lots at this point. Now, instead of using 2 lots, I think it's going to be a good idea to maybe break this down into 2 1 lots. Wouldn't that make sense? Like if you're on a setup which you're not unsure about or which you're not sure about, you may want to break down your 2 lot into 2 1 lots. Or sometimes, we get a setup which is risky. Let's say if you're not that confident in a setup, and you may want to break this down into 4 positions, and that may be 4 0.5 lots. You have 0.5 and you have 0.5. You have 4 0.5 lots. You may break down positions in 4 0.5 lots, and that's what's going to constitute dynamic risk. Now, to break it all down, static risk is where you are using your complete risk, right? And always remember, whenever you're using static risk, you have to manage risk. So we're going to talk about managing risk in the 3rd section of this virtual class. You have to manage risk if you're using static risk. If you're using dynamic risk, you're basically managing risk even before when you're taking the trade, right? So that's the difference. Dynamic risk is where you break down your full risk into multiple positions. Static risk is where you're using the entire 1 risk. Let's say this is 1%. Static risk is where you're using your complete 1%. Okay? Very basic stuff, nothing complicated. Let's move over to part 2, which is going to be applying static and dynamic risk based on candle conformations.